It is a simple truth that markets have no soul, no moral purpose. They exist solely to trade commodities for profit. What becomes a commodity? And the steady commodification of everything has been a hallmark of our moment. Could a river be a tradable commodity? Well, maybe not, but the water in it? Now, when a water trading market was introduced to the Murray-Darling Basin in 2004, a perplexing and dominating beast was unleashed. Buying and selling water, it falls freely from the skies, but this commodification unleashed a ruthless market, and one that pits institutional traders, banks, brokers, the like, against farmers. Well, you can guess who often loses there. The other loser, of course, is the environment. Well, that and any Indigenous claim to this sacred Australian resource. In the second of L&L's Murray-Darling series, I'm very pleased to welcome historian Stuart Kells. He's a serial offender in this program. He has co-written with Scott Hamilton, Sold Down the River, How Robber Barons and Wall Street Traders Cornered Australia's Water Market. Stuart, welcome.
Hi, Jonathan. How you going?
Look, well enough. This water trading system, how was it imagined that this would work?
That's a really good question. And yeah, your setup's spot on. And it goes right back to Adam Smith. You know, people talk about Adam Smith as being the sort of, the advocate of free markets and all that sort of stuff. But even he emphasised that you can't have an effective market without integrity and without strong institutions and all that. And, what we've really discovered recently, and that includes the ACCC report that came out earlier this year, is that the people who set this market up really didn't know what they were doing. They left out really important basic steps like around clear property rights and integrity and information and that kind of thing.
What did they think they were doing?
Well, good question. So this is a sort of complicated idea around the definition of market, but a lot of this boils down to language and meaning of words. With natural resource management, we often talk about using markets to sort of harness the process of buying and selling in a benign way, and so we can replicate that. And it's sort of used in a metaphorical sense, right? So you can create a market in carbon credits, or you can create a market in, native vegetation on private land. And the idea is that you limit the kind of trading of it, and you limit who can come in, and you define the thing that's traded, and you get a little bit of the benefit of the buying and selling, right? And you call that a sort of a natural resources market. But what's happened here is that they've taken it, rather than do it metaphorically, they've actually taken it literally. And so they've created an actual financial market in this stuff, and they've let in the same people who are trading stocks and Bitcoin and derivatives. It's exactly the same people doing exactly the same, stuff, using the same sorts of tactics: high-speed trading, arbitrage, probably elements of front running, which is getting ahead of other people's trades, using their information against them. So it's not a kind of a natural resources market. It's turned into a Wall Street style market. And as you said, on the one side of that, you've got these sort of professional traders who do this as their daily work. They just go to their trading rooms and they just specialise in doing this. The other side of that is you've got farmers who are trying to be farmers and occasionally buying and selling water. And, the obvious consequence is that there's this huge power imbalance.
So explain to me how this works. I mean, I imagine I am a megalitre of the Murrumbidgee. So what happens to me then? I guess I am part of some allocation to a farmer. Is that where the tradability commences?
So it used to be that if I bought some land near the Murrumbidgee, there would be a water right attached to that. And so I'd get a certain allocation of water every year. There'd be some risk in that. There might be a yield which would vary, but generally I'd get a high level of my entitlement attaching to that land. In the early 2000s, two things happened. The water entitlement was split from the land, which meant that it could be sold and separated. And the actual entitlement was broken up into different bits. There was the sort of permanent entitlement, the ongoing into the future flow, But there was also an annual allocation against that entitlement, which was separately tradable, and then all sorts of other things as well, like delivery rights and et cetera, et cetera. So there are multiple water markets. There are markets in those long-term entitlements, the permanent water. There are markets in the annual and seasonal allocations against those rights. There are markets in leases, and there are markets in things like forward contracts and even options and other more exotic things. So it's a bit like what happened in the mortgage security market, where boring old mortgages, which
that
used to be
ended
attached
well.
to banks, exactly. There was this sort of hidden complexity inside a mortgage, and they blew up the mortgage and ended up blowing up the financial system. Very similar is what's happening in water, where this hidden complexity has been unleashed. And these traders have come in and they're having the time of their lives.
Well, this is where it cries for regulation, for oversight, for really strict enforcement of some fairly tough rules around this behaviour, which I take it are absent, Stuart.
Yes, they are. That's right. So in a normal financial market, there'd be all sorts of different kinds of rules around use of information, centrality of settlement, avoiding market manipulation, all sorts of different things, avoiding conflicts of interest between brokers and clients and that kind of thing. Pretty much none of that applies to this market, and that's through a deliberate decision that the ASIC Act and the Corporations Act does not apply to these water markets. So not only do you have the same people who are doing all sorts of fancy things in derivatives markets doing things in these markets as well, but they can actually go a lot further in this market. They can create false impression of active trading. They can cozy up to brokers in ways that really aren't in the interests of other market participants. They can post false prices. They can report or underreport trading. There's all sorts of things they can do. It's a field day.
So at one level, water becomes this abstraction. A thing which can be traded in all these extraordinary ways. On another level, water is water. Water is the thing that the farmer needs to grow the farmer's crop. Where do those two things coincide? or to put that another way, what is the effect of one upon the other?
Well, it's a really good point. So the whole point of the using markets in this space was fundamentally about geography, and it was about agriculture and about irrigation. So it was meant to be about allocating water efficiently to where it could be best used. But what's actually happened is that the market has become estranged from physical place, and so the people who are trading in it really don't care about.
We call it reality.
Yeah, that's right. They're estranged from reality, exactly. And so they don't really care about where the water's going. They care about the price at any particular moment. But it does come together, and as I said, the intention was that the irrigation side of it would be primary. But in fact, what's happened is that the market side is really primary, and that's influencing the flow of water in perverse ways. So if you can do sort of complicated manoeuvres of rights, moving it across different valleys that maximise your arbitrage trading profits, and if you can do clever things with these sort of relationships with agribusinesses and things, and if you can exploit subsidies and anomalies within the system, you can actually make a lot of money in moving water around, and that actually affects the physical movement of water, and it affects the physical profile of agriculture. So our central finding in this research is that there's been this confusion. There's been this sort of wishful thinking, first of all, that the market would get better and better and that it would kind of be all right. And that was never the case, and it hasn't happened. But also there was this belief that the economic return from farming and agriculture would be the main thing that drove where water rights would go. But in fact, what's driven it is the financial return from trading. What's the cleverest portfolio? What's the cleverest tactics, set of tactics you can use? And that's really driving the market, and that's what's driving the allocation of water.
And you've mentioned arbitrage a couple of times here, and I think you should describe that to us and what that means. And there's two things there. A, because it's a perfect illustration of what you just described there, is that sort of disconnection. But secondly, because so few of us know what that means, and that's a real indicator of how this sort of complexity can run its own race, and benefit from the ignorance of the rest of us. So arbitrage.
Well,
What
that
is
sort
that?
of cloak, there's a cloak of sort of ambiguity and complexity that surrounds this market, and all sorts of things happen inside behind that cloak. So arbitrage is just buying and selling for a profit, right? So you buy low, sell high, just like, Gordon Gekko, just like, whoever, American pickers. It's the same principle. But in water, so we touched on that point around unbundling of water rights to create those different kinds of
Yes.
assets, so the long term
Yep.
and the short term and that kind of thing. That is just one of about 5 different dimensions of complexity in this space. So there's types of water rights, there's types of water. So there's groundwater and surface water. There's different rules covering different valleys and different states. There's different irrigation districts. There's different yields, so different levels of reliability. So there's this incredible complexity, which these professional traders invest in and relish, but for everyone else, it's a bit difficult. And the other dimension of complexity is that there are multiple platforms, multiple markets and trading environments. And there's also a lot of trading that happens outside of those market environments. So there's no single market price at any particular moment for water. There's all sorts of different prices, and there's an incredible level of volatility in this space. So the share market might move, if the share market moves 2% in a day, everyone's a little bit freaked out. The water market can move 20% easily. Sometimes it can move, 150%, right? So the levels of movement, if there's just a single rain event, it may change prices by 15 or 20%. So there's this incredible volatility, right? Prices are moving up and down all the time. And there's this incredible sideways complexity across different platforms. So if you're a sophisticated trader inside there and you're looking for opportunities for arbitrage, right, places where you can buy it low at a particular spot and sell it high somewhere else, either in a different market or a different valley or a different time, it's paradise. Because all of these different movements mean there's different expectations of value and there's different prices in different places because there's no centralised information about price. So the traders actually have a better picture of market value than the individual exchanges and certainly the individual farmers. So, if the price moves from sort of $900 to $700, the traders know that the market value at that point is $700, but half of the farmers who are in that space might still think it's $800 or $900, and they use that information against them.
You're sort of answering this question, but I mean, who benefits from this rich chaos, and who is disadvantaged by it?
Yeah, that's right. Well, the reason why these banks and hedge funds and that were let in, going back to that problem of meaning, the word bank means something very different now to what it meant, 50 years ago. There's this whole idea of sort of, being fiduciary institutions and, the sort of local banker and that kind of stuff. That era is gone. And now these guys are essentially, predatory, fast-paced, money machines. That's the first thing. But the idea of bringing them in was to create liquidity, which is sort of about saying essentially that the market would be more stable, that people would be able to buy and sell more often. They wouldn't have to wait to transact and that kind of thing. But instead, 2 things have happened. The liquidity that they're providing is of a very low quality. It's some people in the literature call it junk liquidity because it's really just about taking market rents. It's not about actually helping in a crisis or anything like that. The liquidity is also of low quality in the sense that the spread in the market between bids and asks is very wide, and the liquidity is very expensive. So we as a community are paying literally hundreds of millions of dollars every year for this liquidity that isn't very good, isn't very effective.
Liquidity. What a word.
I know, in the water market, right? And it's all about words. It's words and words, right? And so we've got these banks that aren't banks providing liquidity that isn't liquidity, and they're charging us, a couple of $100 million a year.
Stuart, my head is reeling, and I think that's the intended consequence. Thank you for those words of explanation, and I think that the takeout from it is that this is a hot mess. Thank you for writing about it.
No, a pleasure, Jonathan, and thanks for the chance to talk about it.
Stuart Kells, co-author with Scott Hamilton of Sold Down the River, text publishing. Philip back next week, and there'll be part 3 of our Murray Darling series on wetlands.